Welcome to Capital Impact Strategies. We're going to start a series of videos on Roth conversions. It's a pretty big topic, so we're going to break it into 4 separate videos. Today, we're just going to do an overview of Roths and a little bit of information. Hopefully, we can cover this fairly quickly. And as always, if you have any questions, please don't hesitate to reach out. So, Ashley, you want to give us a little bit of information about Roth IRAs versus traditional?
Yeah, sure. So it's a topic that gets brought up often. People have probably heard the term, but really the basis for the difference is in how the dollars being contributed into the account are treated for an income tax perspective. So I think we're all pretty used to like a 401k plan or a traditional IRA where you're putting money into those accounts which has not been taxed. So they would be considered
Right.
fully tax deferred. Everything that exists inside the account is not it doesn't flow out into your year-to-year income tax return until you start pulling distributions. So versus a Roth account where you're actually making contributions via after-tax dollars. So you've already paid your income tax on this money, and now you're putting it into an account. What makes a Roth different than your regular brokerage accounts is that it is still considered a retirement vehicle, so you get the benefits of tax-free growth over time. There's no RMD requirements, which is another level of flexibility for it. So some similarities kind of to a retirement account, some to brokerage, but the big ones are you're contributing with after-tax dollars, the money grows tax-free, and there's no requirements to take an RMD. Now, if you wanted to pull money from that account, there is a 5-year waiting period. You can always withdraw your principal, but in terms of touching the growth, you do have to leave it in, or the account needs to be established, I should say, for 5 years.
Right. So it's not really a vehicle, so to speak, that we would use for money that you might need access to in the near future.
Sure, exactly.
Okay. So then if we talk about a conversion, we're talking about instead of contributing initially, we've already got money in a traditional IRA. So, actually, as I think about, some of our typical clients, they'll have, large 401k balances that they're rolling over for them from their employer at retirement. And then, we take a look at it and see, are some of these dollars or some of these investments a good candidate for a Roth?
Mm-hmm.
And then kind of talk us through what that looks like, the actual mechanics of converting.
Of doing a conversion, right. So we would have identified a target dollar amount, right, for this tax year. We think we can contribute X to a Roth. That money would then be pulled out of an existing IRA or 401k rollover. So what that essentially does is it triggers the tax on that amount today. So if you were going to do, a $50,000 conversion, pull that amount from the IRA, you'd report $50,000 of income on your return,
Okay.
but then turn around and then make that as a deposit into a Roth and sort of start that 5-year timeline, get these benefits of, tax-free growth, no RMD, et cetera. And it's really a year-by-year tax decision.
Gotcha. So, and I believe that this is accurate. You can actually do an in-kind conversion. You can take actual
Yes,
positions from a traditional IRA, contribute
move it
them to the
over.
Roth.
Hmm.
Okay, so you don't have to sell and then move cash, is my
Right.
point. Yeah. Um, and then, so give us a little bit of why would you consider doing this? Like you're having to pay taxes on this
Paying
money, so I'm
taxes
sure
now,
there's
yeah, why would you do
right, there's
this?
some questions as to why would you even consider doing this?
Yeah, yeah. So I'll say off the bat, I mean, it's not necessarily a strategy that we would apply for everyone, right? It's very specific to an individual couple and their situation. But a few things that we look for when we're thinking through this strategy. One would be if you've got an imbalance to your balance sheet. And so what I mean by that is, let's say you've worked a full career and you've deferred into your 401k that whole time, and that's your sort of main account now that you're entering in retirement and you're going to live off of this, and there's not after tax money to work with, so think about it's sort of one thing to take regular distributions from that, but let's say you needed to buy a car, or something broke, or, any dollar you pull out of that IRA gets taxed at your ordinary rate. So it is a nice way to sort of create another bucket. There's also, tax bracket management. So especially in clients, let's say they retire in their mid 60s, you're not required to take money from your IRA until you're in your, early 70s. So you've got a series of years where you're operating at a really low marginal bracket. And then all of a sudden now you've got these required distributions that are coming out. They can be quite large. So, there is an opportunity in those intervening years to fill up some of those lower brackets by doing conversions. Accomplishes a little bit of balance. It accomplishes some bracket management, lowering RMDs down the line. And then, there are quite a few estate planning related benefits about, you can be more efficient in transferring assets to heirs. You can get into more maybe aggressive investments in this Roth account, which you don't really plan on using yourself. It's sort of setting it up for your kids. That is a broad topic on its own right.
Right. Yeah. No, it definitely worthy of consideration for another entire video. I think you made a great point about the tax bracket management. We've seen clients who transition into retirement. They haven't elected to take Social Security yet. And so you've got, some of those early brackets, especially for, think about like a married couple filing jointly,
Sure.
There's significant room in like a 10 and a 12% bracket. And then, you can obviously go up to, I guess the 22 is the next one. So,
Mhm.
yeah, that can be very valuable. So, again, this is a big, big topic. We didn't want to try to cover everything in one video. We're going to do at least 3 more. And I think next time we're going to cover how you can use this as a estate planning tool. If you have any questions, feel free to reach out. And thanks for watching.